Welcome to today's deep dive into everything you need to know about the pattern day trader rule, also known as the PDT rule. In today's episode, I'm going to walk you through the nuances of how this rule works, who it applies to, because it's not everyone and it may not be you, and the steps that traders are taking today to get around the PDT rule if it does in fact apply to them. We've got a lot to cover, so let's go ahead and jump into the slide deck. Now, what is the PDT rule? It's a pesky rule that was enacted on February 27th, 2001, just after the dot-com bubble. This rule states that any trader with a margin account who executes more than 3 day trades within a 5 business day period, which would basically be anyone who's trying to day trade, be labeled as a pattern day trader. Now, pattern day traders must maintain a minimum account balance of $25,000. Now, that can be a combination of stock holdings and cash, but still $25,000. That's a lot of money. But here's the key word. It only applies to margin accounts. Margin accounts are an interesting type of account in the United States in that they allow short selling, which means you can short a stock and profit as the stock declines in value. It allows you to trade with unsettled cash, and it allows you to trade on leverage. So the trading on unsettled cash is interesting because when you take a trade, it actually takes time for that trade to settle. But in a margin account, they know the trade is going to settle, so they just let you continue to trade. However, in a cash account, you have to wait for that trade to actually settle and clear before you can proceed to take another trade. So that's a big differentiator between cash accounts and margin accounts. Margin accounts, you can short stocks, you can trade within a limited amount of time because you can trade on unsettled cash, and you can trade on leverage. You can't do any of those things in a cash account. So let's talk for a second about the leverage, because this is something that's really interesting. During the dot-com bubble, there were a lot of people who were trading and investing, buying stocks and holding them overnight using leverage. In fact, this was also true during the 1920s. At the turn of the century, there was this big wave of all of these new inventions: the car, the dishwasher, the washing machine, and these were really expensive items. And so the way people bought them was through the use of credit or layaway. You put some money down now, maybe 10% down, and then you pay the rest on a monthly payment. And so in the 1920s, the bankers came up with this great idea to let people buy stock on layaway. Why not? Buy a percentage of General Electric, and now you're in the stock. As the stock goes up in value, you get to benefit from that, and you just have to pay it off a little bit each month. And so the way it would work is if you wanted to buy General Electric, let's say you wanted to buy $1,000 worth, you could put $100 down as a down payment, and the broker would actually buy the $1,000 of stock for you. And now you just pay the broker a little bit each month until you've eventually paid up the total balance of the stock. Now, that's all well and fine when the market is going up. And in fact, what this did was it allowed a tremendous amount of buying on borrowed money. So what it really did was it created a bubble, an asset bubble in the market where people were buying and buying and buying far more than the actual cash that they could afford. So what happens when the stock goes down? Well, let's jump onto the screen share and I'll give you this example. So let's say it was 1998 and it was the dot-com bubble and you had an account with 4 times leverage and it had $1,000 in it. So with $1,000, that meant with 4 times leverage, you could buy $4,000 worth of stock. So let's say you proceeded to buy 10,000 shares of a dot-com stock at 40 cents a share. Well, if the position suddenly dropped to 15 cents, that's a big drop. You would be down $2,500 on that trade. Now, since you only put a deposit of $1,000 in the account, the cushion of equity in your account is gone. And now the broker is at risk of losing the money that they let you borrow for the trade. The result is a margin call. The broker issues you a margin call, and this occurs when you lose money that you borrowed from your broker. So while the broker will attempt to collect this money that you are now in debt to them for, if they're not able to, the broker is the one that's on the hook. So what happened during the dot-com bubble, this is exactly what happened during the 1929 stock market crash, is all of a sudden you had the banks that were going out of business. You had brokers that were blowing up. I mean, yes, they had individual people who owed them money, but their ability to collect that money was non-existent, which means they were the ones who were stuck. And so when the banks go under, that's a major problem. And so what we know, and this happened again in 2007, 2008, in the financial crisis of subprime mortgages, right? So we had this big burst again, and following these big financial meltdowns, regulations come in to try to tighten things up to secure the industry. And so in 2001, the PDT rule was one of the steps that were taken by regulators to try to prevent brokers from blowing up. It's not, to be honest, it's not about retail traders losing their money. Retail traders lose their money, so what? We're idiots. We're retail traders. It's when the banks lose money. That's when there's a problem. You look back at all of the big economic declines, the recessions, the depressions, when the banks are at risk, that's when the whole system is at risk. So that's the thing, is these are regulations designed to protect the broker. They may say they're designed to protect retail traders like you and I, but I don't really buy that. I really think it's about protecting the broker. So now, with a $25,000 minimum in the account, you've got $25,000 minimum. Yes, you still have 4 times leverage, which gives you up to $100,000 in buying power, but your cushion is a lot bigger. So here, you could still, if you wanted to, you could still buy a huge position on a 40-cent stock, but as that price starts to decline, all the brokers have sophisticated risk management software running where in real time, they're flagging accounts that are at risk of having a margin call. And what they can do is they can auto liquidate the positions that account is holding to try to reduce the risk of the broker. Now, further steps that a lot of these brokers will end up taking is they actually will restrict trading on stocks that they think have higher likelihood of causing these types of losses. So this rule of the PDT rule is really about, yes, it prevents investors from trading on leverage unless they have $25,000, but it gives them the bigger cushion. So ultimately, who's really safe is the broker. And so we often see that brokers will put these margin restrictions on a number of different stocks. For instance, they might say there's no margin and you can't use any leverage on a stock under $3 a share, right? So when I actually pull up the level 2 window right here on a stock, I can see how much leverage I can use. So on NVIDIA, I can use 4 times leverage. 25% means that's how much cash you have to put down. This still is like almost like, it is a residual from the how much you have to put down to buy the whole thing. You only have to put down 25% to buy the whole thing here on NVIDIA. So you get 4 times leverage. On this stock, you have to put down 60%. And on this stock, you have to put down the full 100%. So here, you can't use your leverage. Now, if you were trading in a margin account, you could still day trade this as much as you want, right? Because you can trade on unsettled cash. So you can buy, you could sell, buy, sell. You could do that a million times in one day, but you can't use any leverage. So what's interesting here is that you have a PDT rule, which requires traders to have a minimum of $25,000, which is really, so when they're trading on leverage, there's a bigger cushion. And then the brokers turn around and restrict leverage. So if you're going to restrict leverage, then why don't you just let us trade on unsettled cash, even if we only have $1,000 in the account? So here's what I think. What I think they should have done, and of course no one asked me, my opinion doesn't matter, but what I think they should have done is rather than creating a new rule that stated you need to have $25,000 to trade at 4 times leverage, they should have instead created a new account type, which is a margin account with no leverage. Just give people margin accounts with no leverage. Then they can day trade, but they're not trading on borrowed money. But no, they wouldn't want to do that. Why not? Because they want you trading on borrowed money. They want you trading on borrowed money because that means you're trading bigger positions and they get paid the more you trade. And the bigger the positions are, the more money the exchanges make. So, the system is all sort of reinforcing itself. Like, yes, they come in and they add some of these regulations to help prevent the banks from blowing up. But at the same time, they're still just reaffirming what they really want, which is you to trade. So now what a lot of traders do is they say, well, geez, I want to day trade and I don't want to trade in a cash account. So now I've got to go borrow $25,000 to put it into my account. And the brokers are like, cha-ching, that's exactly what we wanted, a bigger deposit. Yes, please go borrow that money from whoever you need to. Now, that's not the best way to get around the PDT rule. And that's not really getting around it. That's meeting the PDT rule by borrowing money. And I've heard of people that have done things like take out a loan on their car, do something really irresponsible just to come up with the money so they could trade. That's not a good idea. There's better ways to deal with this. All right, so the margin restrictions are a major problem. And your number one best way to get around the PDT rule, if we're gonna be honest, is to simply use a cash account. So if you're using a cash account, you can trade an unlimited amount of times until you run out of cash, right? There's no restriction of the number of trades you could take. It's just you trade until you run out of cash. So the best way to get around the PDT rule is to use a cash account and focus on building consistency and your account value slowly and steadily. Once the account crosses over 25,000, at that time convert it to a margin account. That's exactly what I did on my recent small account challenge using Charles Schwab and the Thinkorswim platform. It took me about 16 days to slowly grow the account. Now, it wasn't that slow, but I grew it up to a little over $25,000. And then I knew at that point I could switch it to a margin account. So is it ideal? No, but in a lot of ways, I think it's good because it forces you to be disciplined. You're going to trade less because you know you're going to run out of cash. So you're going to focus on higher quality setups. You've only got a few trades each day. You want them to be the most impactful so you can grow the account. You don't want to take losses. So it's going to force you to focus on quality over quantity. So I think it's a good way to grow an account. And it's a good way for a beginner trader to get started. But I understand that not everyone is going to want to do that. So it's worth noting that it is only US residents that the PDT rule applies to. So does it apply to you? So look in the mirror and say, am I a US resident? If the answer is yes, then it applies to you. If the answer is no, then it does not apply to you. Okay, so here's the thing that's really interesting. It's actually US brokers that are required to enforce it. As a US resident, we're not prohibited from day trading with less than $25,000. If we want to go open an international account, we can go do that. That's our choice. We're allowed to do that. But US broker dealers are not allowed to have anyone day trading unless they have a minimum of $25,000. So this is what this essentially means. If you open an account with E-Trade, if you open an account with Charles Schwab, any of these brokers in the United States, Robinhood, whatever, they're gonna enforce this minimum on you, even if you're an international customer. So if you're from Ireland and you say, oh, I wanna open an account with Webull, and I'm gonna spare you by doing an Irish accent here. Now that was forgiven because I didn't have to spare you, but I spared you. Then you could open an account here in the US, but you would subject yourself to the PDT rule. So now you'd have to fund an account with a minimum of $25,000. Why would you do that? Well, there are brokers here in the US that you might really like. They have features that you really want. Maybe a direct access broker, maybe a broker that has great availability of shares to borrow, a broker that just has really good routing, whatever the case is. You may be interested in opening an account here with a US broker, but you would subject yourself to the PDT rule. So as long as you can afford it, it's no big deal. It's not an issue. But if you can't afford it, then you might say, well, maybe I shouldn't. So non-US residents don't have a PDT rule. So for instance, if you're in, let's say you're in Australia. You're in Australia and you have two choices. You could open an account in the US, $25,000 minimum, or you could go to Webull in Australia. So Webull has dozens of different branches. They have a branch in Canada. They have one in Mexico. They have one in Japan. They have one in Australia. They have one in Singapore. So they have all these different branches. So if you're in Australia, you could just open a Webull account in Australia. Same with Interactive Brokers. Yes, Interactive Brokers has US offices, but they also have international offices. So you can open with the branch that's in your jurisdiction or your nearest jurisdiction if they don't have one right in your country, and they'll usually accept you. And then you don't have to face the PDT rule because it's an international branch and you're an international customer. So now you're thinking, oh, let's all just go open accounts with Australia's, branch, broker dealer, whatever it is, Webull or Interactive Brokers. Not so fast. See, they're going to check to see what is your residency. And they're going to see your residency and your address. They're going to look at your passport, just like they have to open a bank account. And they're going to say, no, sorry, we're not allowed to do that. We're going to get in trouble. So they don't want to help you skirt the rules. So they're just going to say, nope, sorry. But if you're an international trader, if you're not located in the United States, then you don't have to subject yourself to the PDT rule. So there's a little bit of a question here of what actually constitutes a day trade. And just to be entirely clear, one buy order and one sell order is a trade. That's one trade. If you buy twice and sell once, that's also one trade. If you buy twice and sell twice, that's also only considered one trade. A trade is a round trip. So you only change directions once, boom and boom. So if you buy, you sell, and then you buy back and sell, that's actually two trades. If you buy, sell, buy, sell, that's two trades. If you buy, sell, that's three trades. Each time you change directions, it's considered a trade. So if you do more than three of those in 5 days, business days, then you'll get flagged. So if you're on your Thinkorswim account and you have a regular account with Thinkorswim, I'm going to try to bring my account down here to show you. It'll actually give you a warning up here. It's not going to on mine because I'm above the PDT level now, but it will give you a warning and it would tell you the number of day trades that you have left because they don't want you to go over the number that you have left. Now, if you do go over, you get one free pass. The brokers basically, they give you one free pass. So you say, I'm sorry, I didn't know what I was doing. I didn't realize this rule existed, whatever. And they'll say, okay, that was your one free pass, but do it again. And we're gonna restrict your account to not allow you to trade unless you add the money to get to $25,000 or you switch it to a cash account. So then you either have to switch brokers or switch to a cash account. So you don't want to have this happen where you're kind of getting in trouble with your broker. So the best ways around the PDT rule really at this point would be if you're a US resident to trade in a cash account or to trade in a margin account using an international broker dealer. And this is really going to work the best if you're an international resident. Interactive brokers, Webull, TradeZero, these will only accept non-US customers. They don't accept US customers. CMEG is the exception. And there's a couple other international brokers that are also exceptions. I'm not going to list them all, but CMEG is one that I've personally used, and I didn't have any issue with it. So CMEG will accept international customers, but they're not allowed to advertise to US residents. So they'll accept a US resident in addition to international customers, but they can't advertise to us. So if you do their account application, you have to affirmatively declare that they did not solicit you. They didn't advertise to you. You're just coming on your own accord because you heard about them. And so in that case, they'll service your account, they'll let you open it, and they will not enforce the PDT rule on you. They're one of the few brokers that are in this sort of gray area of they're an offshore broker dealer, they're located in the Caribbean, they don't enforce the PDT rule, and they also are willing to take on the risk of accepting US customers. Why do they take on the risk of doing that? They charge commission. They make money. They get paid. So they get paid on the commissions and they get paid on the platform fees. Whereas Thinkorswim is free. Interactive brokers using the light version is free. Webull, well, it depends on where you are, what jurisdiction. Webull's not free in all jurisdictions. And actually neither is Interactive Brokers. And TradeZero is free, but is only works for non-US residents. So I would say at this point, if you're a US resident, your best bet really is to focus on trading in a cash account, to build a track record of consistency, prove that you can be profitable in a cash account with those restrictions. And if you can, then you make a decision. Okay, I've grown my account from $1,000 to $2,000 or $3,000, but took 6 months or a year to do it. Now I've got a track record, I know what I'm doing. Am I willing to take the risk of using an international broker dealer for a period of 6 months? I'm going to pay more money for it. If there's ever an issue with my account, I'm not going to have the same resources or, I'm not going to know exactly what to do. Like, look, if a bank here in the US didn't let you get your account, you know what to do. There's US attorneys, there's things you could do. If that happened and you're dealing with a bank in Australia or a bank in the Cayman Islands, your remedy is limited, if you're going to be honest, right? So I would never put more money in an offshore account than I would be ultimately comfortable losing if worst case scenario happened. However, having said that, I've used a number of offshore brokers over the years, and it is something that I think of as a tool. It will allow me to trade. I could trade far more quickly. And therefore, for me, given my skill set, I can grow an account far faster than when I'm trading cash only. But there is a cost to using that tool, both in the commission and the platform fee. And there is a risk to using that type of tool. You don't have US federal deposit insurance and all that stuff. You don't have the same recourses if something does happen to your account. So it's a risk that you have to take. So again, at this point, given T1 settlement, trades settling overnight, as long as you can fund your account with at least $1,000, you could trade every day. And you know what, for me, and this has always been my goal, when I'm looking for stocks to day trade, I'm looking for a stock that I think has the potential to go up 10%. So now let's think about this for a second. Let's jump back onto the whiteboard. We're looking at a stock right here that's, let's just say $3 a share. All right, so we got a stock that's $3 a share. You've got $1,000 in your account. All right, so now in this stock, how much can you buy? Approximately 300 shares, right? So you're buying about 300 shares. If you did 1,000 shares, that'd be $3,000. So 300 shares, you're going to be at 900, whatever. So go up to 333 shares. Go all the way to the max, or whatever it is, approximately. So max it out. You're buying the full $1,000 worth. And if this goes up to what, 330, that's 10%. So now all of a sudden I'm growing my account. I'm selling up here at 330 and I'm up about, $99, right? So it's about $100 in one day. For me, my goal on a good day with a small account is to grow my account by 10%. Now I know there's options traders out there that are doing YOLO trades with, 0 days to expiration, and they're looking to buy something at 10 cents and it goes to like $2, a contract, 20x return. I'm not buying lotto tickets. That's not my strategy. My strategy is to focus on stocks every single day that are on the scanners with news that I think have the potential to go up, from my entry, 5 to 10%. Now that means the stock has the potential to go up higher than that because I never capture the full move. But if you're focusing on the right stocks to trade each day, I don't think it's unreasonable that you can grow a small account. Is it going to be slower than if you're unrestricted and can trade on leverage and trade all day long? Sure. But if you're a beginner trader, let's be realistic about your skill set. And the more likely thing of trading on leverage as a beginner is that you could lose money. And the brokers don't want you to lose money. So even those offshore brokers like Trade Zero and CMEG, they're still going to restrict you. So if you fund an account with one of those brokers, even though you could get 4 times leverage, or in the case of Trade Zero or CMEG, you can get 6 times leverage, they're not going to allow leverage most likely on stocks under $3. So now you see those cheaper stocks, it's not even going to be an option. Or you see a stock that's $5 a share, but because the stock is already squeezed up, let's say 50% or 100% on the day, the broker is going to flag that as being a high risk stock, and they're going to immediately take away your use of leverage on it. So this gets super frustrating because you spend the time and money to open an offshore account, and now they're doing the same thing the US brokers do. They're restricting leverage, and now you've got your hands tied. You can't trade the stock the way you want. You're back to having a cash account. I mean, again, it's not exactly a cash account because it settles, but you're back to having an account with no leverage. So if you're really banking on using leverage, I'm just going to tell you right now, full disclosure, you're probably going to struggle. It's going to be hard. If you are banking on using leverage to growing your account, that's not the right way to learn. It's a better way to learn by focusing on growing using your cash balance. I know it's nice to have the leverage and to buy 4,000 shares of a stock using 4 or 5 times leverage, but you're taking a lot of risk doing that. And the types of stocks that we really want to trade, most likely, leverage is going to get restricted from you anyways, and then you're not going to be able to take the trades the way you want to. So it's going to backfire on you, and you're going to be disappointed. You're going to be paying extra fees. So now you've got a really good understanding of the pattern day trader rule, who it applies to, and the nuances of it, especially with cash and margin accounts. If you want to learn more about trading, perhaps you're interested in trying to find the best stocks to trade on any given day, I've got a couple more episodes you might want to check out here and here. And as always, if you enjoyed this episode, I hope you hit that thumbs up, and I hope you subscribe to the channel for more episodes about trading strategy just like this. Thank you as always for tuning in. And a reminder, trading is risky. My results aren't typical, so please manage your risk and take it slow, and always practice in a simulator before putting real money on the line. I'll see you for the next episode real soon.